Andrea, we're looking today at SME investment. There was a recent incident where a company failed to, in a sense, get going. So what was the incident?
It was private equity firm Jacana who had stated that they were going to raise a $75 million US fund for SME investments. And they had also, I think, a good year ago and a year and a half ago, announced that they would acquire / merge with Fidelity in Ghana and in return in Kenya to sort of build up their operational capacity. And what turned out is that they ended up closing their London office because they were, from what I understand, not making sufficient progress with the fundraising process. They basically cancelled those plans for the $75 million fund. And from what I also understand from In Return, who are now still branded Jacana in East Africa, is that the mergers with both companies never really went through. So the brand is sort of still there, but the original company is no longer.
Let's take the camera out a bit. What does this tell us about the broader problem of finding money for SME investment and SME investments?
We're still thinking about this because it's not obviously not the first fund that failed to raise its target or just basically abandon the fundraising process. I think one issue that we see here is that there have been so many SME funds over the past few years crowding into this space that LPs, i.e. the organizations that put money into those funds, would really probably like a new concept, something that would differentiate anyone now raising funds for this to go into the space from others who already operate in the market. They're probably more demanding now. They would demand more capacity, more market insight, whatever it is that makes you stand out from it. Because if you end up with the same concept, the existing funds that target the SME space that they already have, then there's the deal flow is still a challenge. So you would really have to show that there's something new that you can contribute.
What's the performance like for these SME funds you're talking about?
It's a really good question. Nobody really knows because there've been very, very few exits, and everybody is sort of keeping their cards incredibly close to their chest. So I think it's really too soon. I don't think there's been, especially in the smaller SME space, amongst the newer funds, anyone who had fully invested and then exited their fund, because it's also worth bearing in mind it's a very young industry. So there are lots of funds that are still in the investment phase. There are a couple of older companies like Aureus, for example, who were acquired by Abraj, but they work in a slightly higher segment.
Typically what kind of companies are, if there is any generalities that can be made about the kinds of SMEs that they're putting money into? Something
that is still very interesting, not just for the SME funds, but for all private equity funds, is any consumer-facing industries. So we've seen generally a lot of interest in that, whether it's financial services. There've been one of the interesting deals. It's probably not a proper SME space, as ECP, who invested in Java. That's a very sort of middle-class, consumer-class deal that was made. There's a lot of experimentation with companies that target a sort of broader mass market, lower income clientele. There's a lot of interest and also experimentation in the healthcare sector, for example. And then, as I'm sure you know, a lot of buzz generally about the ICT sector, with probably not quite the deal flow that you would anticipate just from the whole hype around it.
Why is there not the deal flow from the tech sector? Because, as you say, from the hype, you would imagine that deals would be made. Because
I think part of that hype is sort of around a very, very different segment. I think the potential for the ICT sector in itself is enormous, but the companies that would attract SME funds are those companies that have just not been that much in the limelight. So they're not in that whole startup environment that attracts a lot of media coverage and a lot of the hype. There's sort of normal companies doing a lot of business-to-business work. Cellulant is one example that had an investment by TBL. Mirror Fund is sort of proper SME fund working in the sort of lower end of the market. They work on banking mobile platforms across sub-Saharan Africa. So there are no stories of mobile applications for farmers or any of that stuff that make for such cute stories. But in the end, it's not quite clear if there's really a business model behind it or an actual proper market. So I think it's a sort of, there are two strands to it, where the real potential is just not getting that much enthusiastic media coverage, whereas the institution, organizations like the iHub, all those tech hubs, all those competitions, they sort of push the media stuff, they push the media coverage. I think people just generally get very excited about it because there's this desire for the good story from Africa and how technology can change everything that doesn't work properly. And I think the transition to actually finding, a lot of those so-called startups, they're sort of a couple of kids with laptops or a kid with a laptop or mobile applications. They're not necessarily actual companies yet.
They've got no trading track record.
Well, they've got no track record. They're not properly incorporated. They're ideas yet. It's very much an ideas stage. And I think an argument that's been made by a few critics is also that all these competitions just distract people from getting actual work done. People chase after the competition award. They go from competition to competition. They don't really focus on creating an actual company and thinking very carefully about their markets and their revenue streams and everything. And then you've also got, I think, quite a few competitions where there's always a sort of developer angle to it. And that often makes it very challenging to figure out where the revenue really is going to come from, because if you run it as a development service as a priority and you end up not making proper money with it or subsidizing it, then there's a limit to how far you can grow, and that ultimately will be a challenge for any investor to see how they can put the money and grow the company and then exit successfully, which is what private equity firms want to do. And so for those people, another form of financing might possibly be a lot more suitable. Apart from the fact that I think so many of them are so young that it's just too early to really look at an SME private equity or a venture capital fund. They probably need an angel investor and somebody who takes them by the hand and says, look, I've grown businesses before, I'll show you how this works. I've once argued that a lot of those kids should go be employed for a couple of years and got shouted at quite horrendously for that. But I think that is still a case to be made, that once you've worked in a company for a couple of years, you understand how a company works. But then, of course, the formal employment sector in sub-Saharan Africa is often very limited, so that may not necessarily be a choice.